welcome everyone. I'm Aliana Pinedo. I'm the Chief Impact Officer at Boston Impact Initiative. Welcome to our webinar, Lessons on Solidarity Finance, featuring our CEO, Betty Francisco, and a BII investor, Smitha Das, from World Education Service. We have a full hour today, which is really about one question. When you're trying to move capital towards economic justice, how do you find the right capital and the right people on the right terms? And so our format today is a fireside chat between Betty and I about her report on lessons in solidarity finance, followed by a conversation with Smitha Das, who will share her perspective on BII as an investor. And then we'll open it up for a few audience questions, so be keeping those questions in mind as we go through. The report, Lessons on Solidarity Finance, How We Raised $22 million for Economic Justice and What It Reveals About the Opportunity Ahead, has 12 lessons, and we encourage you to read it. But today we're only going to be covering 3 of those lessons related to co-design, who we raised from, and the role of philanthropy. And you should be able to see a link to the report in the chat. Please dig in after this call. We'd love for you to read it and give us your reactions afterwards as well. So let's see, we have a wonderfully mixed room today. I'm going to look at the chat quickly and just see who we have. Oh, no one's introduced themselves in the chat yet. Y'all, you got to tell us who you are. As a reminder, share your name, organization, location, and what kind of capital you're trying to move or raise right now. We'd love to see who you are and what you're up to in your places. So don't leave us hanging here. Okay. So the other thing is, in the chat, I'd also love for you to mention if you're a fund manager, investor, advisor, investor or advisor, funder, foundation, or if you're just curious, you know, what's going on here and wanting to hear about what we're doing. So for those of you who are new to BII, let me introduce us. We are a nonprofit impact investing fund and a certified community development financial institution. And we invest in the people and places, building community ownership, shared wealth, and economic power, particularly in communities of color. We provide entrepreneurs, cooperatives, and community-owned enterprises with fair and flexible capital, business coaching and advisory and trusted networks. And we advance inclusive local economies, building lasting community wealth. Since inception, we've invested over $20 million towards about 100 enterprises and community-controlled real estate projects in New England. And we're best known for our integrated capital approach, where we tailor investments to the investor and blend debt, equity, and grants together with social capital. Through our ARC Fellowship, we've trained over 90 impact investors and fund managers to launch community-based impact funds, with 29 already raising and investing nationwide in their communities. And we're building a community of practice for these impact-first investors that drives economic justice. So many funds that are raising today will tell you that it's a challenging market. And now I want to turn it to Betty, who will set the stage for us. What is it about this time that is both challenging but also an opportunity? Welcome, Betty.
Thanks, Aliana, and thanks to our audience that joined today. We're really excited to have you here and to get a little bit of the insights, right, that we've gathered from our Fund to Raise. So, Aliana, what I learned throughout the raise was that I often kept hearing sort of that deficit mindset. There's not enough capital, right? That we're all sort of vying for the same pot of money, but there actually is a lot of abundance, right? So I think that we're in unprecedented time where the thing to keep in mind is that impact capital does exist. It's abundant, but it's looking for a home. And when you look at the trends, right, for over the next 20 years, we certainly see, right, there's going to be a historic wealth transfer that's already happening, something like $124 trillion is going to move from older generations to the next gen and into charities. And that'll be happening over the next 20 years into 2050. A report by Cerulli Associates projects that about $105 trillion is going to go directly to individuals through inheritance and wealth transfers, and 18 trillion is earmarked for philanthropy, money that's going to go into foundations, DAFs. So it's not surprising that the global impact investing market is growing too, right? It's reached 6.6 trillion, and 1.6 trillion of that is in the US impact investing sector. And then what we see is this next generation, right? My kids, your kids soon to be, as they get older, want in, right? Morgan Stanley has a report on sustainable signals that showed that most Gen Z and almost all millennials want their money to reshape capital markets to benefit community and planet. And they're rejecting that trade-off between sustainability and profitability, right? So they're looking for these impact investing opportunities. So the question has never been, is there enough capital out there? It's really whether we can build this infrastructure to receive it and deploy it fairly, particularly in communities of color where traditional finance has been left out. So that's the opportunity that we're responding to and from which we built Fund 2.
Mm-hmm. And so, Betty, let's make this concrete. You closed Fund 2 at 22.3 million, above our $20 million target. And you did this during what might have been the hardest political climate for this work in a decade. How did that happen?
Yeah, so I joined BII in 2021, right? Came here to start designing the fund, but we were coming out of COVID, the COVID pandemic. And I would say it was an exciting time to shape a new fund because there was such great support, right, for racial equity. A lot of the corporate commitments, right, were in the billions for racial equity. And we saw, let's ride, right, that trend. But soon after we launched Fund 2 in late 2022, we started to see the political tides change, right? So in 2023, after we launched, the ground started to shift. Corporations began walking back some of these 2020 pledges. The Fearless Fund case, right? This case that came down in August 2023, I believe, against the Fearless Fund because of the grants they were giving to Black women business owners, right? Challenging grant making, right, based on demographics or particular race constructs. So that coupled with the Supreme Court, right, then coming down with the decision that struck down affirmative action in higher education, started to have a ripple effect on even our sector on impact investing. So programs that were being built or have been built around racial equity started to get dismantled. And we see that all around us now, even with the policies of the current administration. So that's the backdrop that we raised into, right, where the shift has been significant. So I think that is partly why it took us 3 years to raise Fund 2, right? We had a slow and moderate timeline, but it took a bit longer because of the environment that we were in. I'm still really proud that we raised 110% above our target, right? From 235 investors, 24 states. And the lesson I took away from this is that I believe that even though institutional support is going to fluctuate no matter what, given political headwinds, right? These are cyclical trends. Investor demand for place-based investing for community control solutions is not going to go away. People want to invest in their community. And there is a large underserved market for values-aligned investors. They're looking for vehicles like BII, for our ARC fellows to invest their capital.
That's right. And I'm curious from the audience and the diverse group of folks that we have here, some of whom who have introduced themselves in the chat. I'd love to hear from the audience what barriers you're facing in raising or moving capital right now. So in the chat, if you could just put, one word of the biggest barrier that you're facing in the moving or the raising of capital in this moment. And as we see the chat, we might be able to see if there's some trends here that you experienced as well, Betty. So I'll give everybody just a moment to put your comments in there, if you will. Oh, okay, well, we will see. So, understanding the variety and types of impact capital and the true cost of capital. That's a really good one, Hannah. And
Oh,
the
that's
gatekeepers that are wealth advisors. Yeah, you can have really allied ones, or there can be ones that are gatekeepers. Yeah, exactly. Um, Excellent. Well, we'll see more come through there. Um, but, as we get into this next stretch of the call, we'll think about a couple of these topics here that are being mentioned, and there's more in the chat now. About how we worked through some of these challenges that we're seeing here. Um, so before we get into who we raised from, I wanted to start with how we built the vehicle, the thing that they invested in, because I think that that's the part that people underestimate, is the design process. And so we didn't design the Fund 2 note, in a room by ourselves or on Zoom like this by ourselves, right? Um, Tell me, Betty, what were we doing and how did we do it?
Yeah, it's such a great point because when you think of designing a fund, you could do it about around, just what you think the trends are and the need in the community. But we were really intentional about a co-design process, right? So I remember back in those days, like meeting with our portfolio companies, with entrepreneurs in the community, to try to understand what is needed right now. I'm really proud that we co-designed this fund with the very people it was meant to serve. So our entrepreneurs, and then also our investors, because Fund 2 is what we call it. It provides democratic access, right, to community investors to participate. So we wanted to understand what would it take to help bring in unaccredited investors into this fund. Many conversations with portfolio companies, entrepreneurs, our Fund 1 investors, because this is our second fund, and with community partners, right, to shape the actual terms around the notes and to shape it around real needs. And if you remember at that time, right, we were coming out of the COVID pandemic, there was a lot of debt capital in the market, right? And Fund 2 is an integrated capital fund. We invest debt, equity, and sometimes grants into businesses. So we were trying to see where was the need at the time. More equity capital was needed at that time, right? More patient, flexible capital, longer term, that could give entrepreneurs more runway to stabilize their businesses and then grow. And that led to us shaping, right, that community informed process helped us shape 3 tranches of notes: our community note, which is a 5-year 5% note, and then our solidarity and philanthropic notes, which are 10-year notes. One is 3% and one is 1%. So when you consider, a 10-year note, right, that's a long term for some investors. And when we were vetting that, there were a few advisors even that said that 10-year lockup is too long, right, for a community investor to have to wait 10 years to get their money back. And that led us to create a 5-year note instead, but with an incentive to reinvest, to keep that note with BII. So after 5 years, so in 2027, our community investors have the ability to say, yes, we want to reinvest, and their interest rate goes from 5% to 7%. So there is an economic benefit, right, to staying with BII. Also, when institutional partners told us that they were willing to take a 1% or a 3% note, right, they did that because they understood it would open up the door for other community investors to come in. And so that was what allowed us to build the tiered note structure. And it was really important for us, to democratize access to the fund so that everyday investors, community members could participate, what we call the non-accredited investors. But the accredited investors, the wealthier investors, they play a role in that, right? Because they accept lower returns. So our community members who have less ability to absorb risk can participate at that higher return. So why does that matter for fundraising, right? Sometimes when you don't have a first fund, right? We benefited from having a Fund 1, have built up track record. But when you're designing, it helps to design with investors in mind as well, right? Because they then were advising us, counseling us, but then they became the investors in the fund. So co-design, I don't think should be viewed as separate from a raise, right? It should be part of your raising process. And many of those advisors and community members that helped shape the terms became the first committed investors, right? We'll get to advisors because there was a point in the chat about the role of registered investment advisors. Sometimes, yes, they can be gatekeepers and barriers, but sometimes they could be your biggest allies and champions. And so, I'll leave you with this, that if you're a new manager and you haven't raised a fund one yet, look at community co-design as a way to build credibility from day one, right? With the constituents that you're serving, but including your investors and even donors.
And so the investors, Betty, that we're about to talk about in a lot of cases were people who had already had a hand in influencing or building or designing the fund.
That's right. Yeah, I mean, again, we benefited from having fund one investors that we were able to activate, right, to then participate in fund two, because fund one investors had already been, some of them have been paid back from fund one. Some of them were still in fund one, but said, we want to actually participate in fund two. So they rolled over into fund two as well.
Mm-hmm. Great, thank you. And so this next lesson is really an important one, and I want us to take our time here. When you set out to raise from the investors, some of whom you had never met, so some of whom you had, co-designed with and had previous relationships with in Fund One. So recognizing that, slight advantage, but a fund going from a $6 or $7 million raise to 20 million is a big jump. So there were going to be investors that you had never met. Who opened those doors? How did you get access?
Yeah, so I know this is maybe unique to us, but I will say the ones that opened the most doors were the values aligned registered investment advisors, right? What we call values aligned, mission oriented RIAs. They were the single most effective door openers for us. A couple of reasons, right? They helped us co-design the fund. So they were looking at what could we provide to our clients, like they were influential for us because they helped us understand what clients were looking for, what appetite they would have for a fund like BII, which is a fund focused on racial and economic justice, but it is a debt fund. You are buying a note, right, when you invest in BII. So they helped us understand, here's what the investor appetite is right now. And then they could open doors to clients we would never have access to, because it is the person that mentioned this, there definitely is a lack of transparency, right? There's folks that don't even want you to know that you're who your advisor is, or that you're even interested. So the RIAs, they do play a gatekeeper role, but they play a door opener and access role at the same time. And so what happens is advisors, right, diligenced us. They were able to then make the case to their clients on how BII aligns with that client's values or mission orientation. And they're basically selling us, right, to their clients. That pitch, so to speak, carries more weight than any pitch we could provide directly, right?
Mm-hmm.
So who were they? Firms like Align Impact, right, which is no longer around. But they were really instrumental because they had a catalytic capital practice led by Ishita Shah at the time. Clean Yield, Cordata Capital, Natural Investments, Obran Capital Advisors, Trillium, and more, right? Did diligence on BII, and then they recommended us to their clients, right? So they were able to open that door. And sometimes clients with an advisor that maybe wasn't so values aligned, still we've still made it possible for them to learn from other advisors. So one thing that was really helpful is that some of the RIAs were willing to speak to other advisors to tell them about their experience in BII, right? In some cases, some were willing to share diligence, but in this community, there's a willingness to share, right, what we're learning. So I found that really helpful.
And so where did the patient values first money come from in terms of like what kinds of investors were these?
Yeah. So a few were what we call family offices, right? That have a tranche of their fund or their endowment allocated to what we call catalytic capital. There are some nonprofit asset owners and then individual investors as well. Sometimes these are, families. They may have assets between 20 million to 400 million, but they want a piece of their portfolio to have impact oriented funds that are what we call impact first, where BII lives. And there certainly was a focus on solidarity economy, ownership economy, funds that focus on economic justice and transforming systems. So that is what we're able, with the help of our RIAs, to tap into, to be able to find some of those very values aligned impact investors that were family offices or funds. And to name a few: DF Impact Capital, Mulberry Hive, SK2 Fund. I know we'll hear soon from Smitha from World Education Services, Windy Pines Foundation. So some of them were new to impact investing and some have been doing it for years, but they increasingly were looking to allocate impact first or catalytic capital to their portfolio.
Hmm. And so this values alignment around economic justice and solidarity economy were connecting themes for many investors. Yeah. And so let's talk about a slightly different group, which is faith-based institutions, which collectively hold something like $12 trillion in assets. Were we able to partner with some like who were the partners there and what were the avenues to partnering with these local institutions? They were, interested in some of these topics because of their faith-based values. And so how did you activate this group?
Yeah, so we had a few faith-based investors in Fund One, that some came over into Fund Two. But what was interesting to me was that faith-based investors, right, they were the original funders of the CDFI movement, right? So as we became certified as a CDFI, I started to learn, right, that the community investing movement started with foundations and faith institutions. And so it traces back to the roots of the civil rights movement. Today, many faith-based institutions are adopting what we call faith consistent investing, right? So they're trying to apply their values to repair historical harms. So there is alignment, right, between their values and what our fund two is aiming to achieve around building a new type of economy, but also building wealth in communities that have not been served by traditional finance. So think of the Congregation of Catholic Sisters, for example, right? We also talk about the monks, right? They've been leaders in the community investment field for decades. And these larger faith institutions are following. So I'll say, because we did a lot of work, Aliana, together, right, with the
Hmm.
Episcopal City Mission and their various parishes and congregations. They were really strong participants in wanting to learn about BII and our work and supporting some of the businesses in the community, but also now coming in as investors in the fund. So I found that really, fascinating, right, that we could build those kinds of partnerships with faith institutions.
Hmm. Yeah, and what else surprised you about this kind of landscape of who we were able to raise from?
Yeah. So I think, I've learned a lot from the different kinds of investors we've had. And one two I'll raise up is anchor institutions, right? We sometimes don't think of hospitals or, maybe large corporations that may have a sustainable investment arm. But I'll name Boston Medical Center, right, which is an investor in Fund One and Two, because they were a strong partner to us, right, in wanting to make very, very targeted community-based investments, especially those focused on racial equity. So
Hmm.
hospitals sometimes have, right, their own funding that comes out of community needs assessments that is available to nonprofit funds, right? It could be for a housing investment or it could be for a workforce investment. So don't discount hospitals or anchors in community. The other interesting one was self-directed IRAs, right? So as retirement assets are growing, I think people want to be able to invest both in traditional securities in the stock market, but also into private investment opportunities. So platforms like Alto IRA and Trust Group, and then one of our friends from our ARC Fellowship is Just Futures, right? They're starting to build the infrastructure to allow folks that have retirement accounts to buy notes, right? Or buy securities in private funds. So I think it's something, it wasn't a huge amount of our fundraise, but I think it's a growing trend that should be looked at if someone is raising capital.
Mm-hmm.
And particularly for community investors, because these, the retirement platforms, allow almost everyday investors to participate.
Mm-hmm. Right. Right now, we're going to launch a quick poll. So hopefully everybody is like able to click on something here. But the question is, which investor type feels most reachable to you in our audience? So select, I think you can select a few if I'm not wrong. But select which ones you think are most reachable to you. And if you're not sure, that's fine. You can select not sure yet. So we have some responses coming in, and we'll leave it open for a few more seconds here. So get your responses in
Oh, this is really
because
interesting. Yeah.
yeah, we're seeing it on our side. But yeah, I really want to see, which types of investors feel reachable, feel accessible, don't feel gate kept, as we heard in the chat earlier. Um, okay, 10 more seconds. Got pretty good participation here. And then we can okay, Domenica, I think we can close it. We've got some good
So
responses here.
it's really interesting to see, right? DAFs, foundations, banks, then followed by, community investors. Yeah, yes to that. So I'll mention that we had a lot of, I would say, opportunity, but hope, right? That DAFs, foundations, banks would become a sizable number of the investors in our fund too. And that wasn't exactly the case, right? And so I will say that what was hard about that is, donor advised funds, large foundations tend to move more slowly, right? So with DAFs, it's still the underlying donor that recommends, right? They go to their DAF sponsor and they say, we want to make an impact investment, we want to make a recoverable grant in some cases, or a direct investment in a note. And so the DAF sponsor has to work with that investor. And they're still, I would say, evolving infrastructure that DAF sponsors have to build to be able to allow for impact investments to be made. Some have that already, and some are still trying to figure it out. Large foundations also are sometimes challenging because investments into funds like ours, which we call catalytic investments, don't come down the traditional, investment sleeve. So when you hear about, foundations typically only grant out 5%, right, of their endowment, and the other 95% is invested in securities that return, have a return so that you can keep growing the endowment or maintain the endowment. Usually an investment in a BII is not part of that sleeve because the return is lower. So what we find is that foundations that have created a mechanism, right, either a catalytic capital sleeve, or they've allocated particular funds for program related investments so that they can participate in a BII or in a CDFI investment. Like you have to find those, right? And it's not common. It is more the exception than the norm. And I think that's the opportunity. How do you support and work with and collaborate with more DAFs, more foundations to make it easier, right, to make investments into funds like BII. The last one I'll mention is banks. Because we became a CDFI, part of the motivation was to be able to expand our capital access from banking institutions that get CRA credit for investing in CDFIs I think part of it is because we were still new to becoming a CDFI. We just started to build relationships with banks, but I do think that that is a viable source of capital, maybe at different terms, but definitely worth pursuing. So here's the honest lesson, right? Is that you've got to diversify your pipeline. Don't over invest in certain channels like the DAFs and the foundations without a really clear activation plan, because it does take longer. It can take 12, 18 months, sometimes 24 months to raise from them. And I will say that it's all based on relationships, right? Even with our RIAs, once you build a relationship, doors open, but it's building the initial relationships.
Hmm. I want to swing back to foundations that you were talking about a little bit ago, because when we've engaged foundations, and as you were engaging foundation as raising the investment fund, um, it had also often been from the standpoint of having been a grantee previously, or even at the same time. And so I know it's on a lot of minds, but a fund built on fair and flexible capital cannot cover its operating costs on returns alone. We're not built to be sustainable in that way. So, how should people think about the role of philanthropy in a fund like BII's?
Yeah. Uh, Great question, Aliana. So this was one of the biggest ahas, right, for me. And I feel it acutely right now, right? Philanthropy is what initially funds the infrastructure of our fund, right? It's the staff, it's the back office. And we do rely on philanthropy to help us build that infrastructure. The instinct, I think, is to raise philanthropy over here, right? And then to raise impact investment capital over there. And that's the trap, right? That's why we're advocates of integrated capital, because when you separate it, right, the timing of those grants and who you're getting them from, it creates cash flow challenges. It slows deployment. So separating philanthropy from the investment capital it creates a big cash flow challenge. So I invite us to reframe the role of philanthropy, right, in an impact first fund as integrated capital, and not to look at philanthropy as a subsidy, right? Because sometimes we think of it as it's just plugging a hole, but it's actually the seed capital, right? It's the infrastructure capital to build a new financial system. So if we're trying to change systems with our kind of capital, we need philanthropy to play a role, right? Because honestly, generations of wealth extraction were created that created the capital gaps we see today came from, oftentimes the way philanthropy moved. And so I would think of philanthropy as that layer. It's the grants, the loan loss reserve, the operating support. That's what makes our ability, right, to move fair and flexible capital possible. And the biggest lesson is that you have to raise it alongside investment capital, right? So I will be honest, like I wish we raised more philanthropy alongside investment capital, because that is part of the integrated capital offering. It's not separate. And that's the biggest takeaway, right? For investors too, to understand the role that it plays.
Hmm. Yeah, and can you just dig into that a little bit? So, as if someone gives an investment dollar versus a grant dollar, how are they spent?
Yeah.
Where does each actually go?
Yeah, so we committed that our investment capital, so the notes themselves, that money would go directly into our investments, into entrepreneurs, community control real estate projects, right? So that's investment capital. And that money is the loan, is the equity investment into a business. Grants, though, right? They're the catalytic capital that does everything that makes that possible. So think of the advising that we have to do to prepare a business, right, for capital. So it's the coaching, the advising, the financial projections, the pitch deck, right? All of that to prepare them for access to capital. And then we have to structure it, right? We want to structure fair, flexible terms. Oftentimes that means co-investing, right, with community partners. It's all the time and the work, right, to make a deal possible. And then ultimately for that business to become truly bankable and can get access to traditional finance, right? So that takes hours and hours of coaching, staff time, and then now building tech infrastructure as well. So in short, grants is what gives us capacity, right? And the time to build resilient, impactful enterprises that deliver lasting returns. So if we want to see the impact of our investment activity realized in impact outcomes, we have to support our infrastructure with philanthropic dollars.
Hmm. Thank you. Um, yes, and I think that's like a very concrete, any of the investors and the philanthropists on this call, like that is the
Yeah.
call to action here.
And now,
Betty, yeah.
Aliana, I'll say, because you might say, well, how much, right? Like, I mean, we'd love a lot of more philanthropy, but I would say if I want to pair our investment, right, with a grant that's about 10 to 15% of the investment amount. I think that's a nice coupling, right? If you think of
Hmm.
how much should we ask investors for. So that's us. I think other funds that are in our ecosystem, because they're more catalytic, right? They're providing really, really fair, low cost capital, may need more, right, of a
Hmm.
grant. Um,
That's right. Yeah. Well, Betty, thank you so much. We could talk for hours about
yeah.
this. I really encourage everybody to go read the report. Um, and I want to make sure, that we get to the second part of the call because we couldn't do what we're doing, as you mentioned, without some of our key investors and supporters. And so right now, I'm thrilled to bring in Smitha Das, Senior Director of Investments at World Education Services, a global social enterprise where she stewards the entire portfolio to be 100% mission aligned. She's worked across government, private equity, venture philanthropy, and impact investing. Smitha, welcome. We're so glad that you joined us today.
So great to be here. Thanks for having me.
You're welcome. Yes, thank you. And so while we're speaking, please, I saw that there was one question already in the chat. Put your questions in the chat, especially questions that you might have for Smitha in this section. But we will have a little bit of time at the end of the call to take a couple of questions from the chat. So, Smitha, you are a key part of Wes's journey toward aligning the endowment towards 100% mission. When a fund like BII Fund 2 crosses your desk, what are you actually looking at and looking for?
Well, thanks so much again for having me. It's great to be in conversation. I was taking such good notes, Betty, from from your presentation and conversation. So much good wisdom. What we often look for to start is the partnership piece, right? What is the strength of the partnership angle, whether it's a catalytic partnership, a strategic partnership, a learning partnership, in regards to our investee partners. And so I really loved how, Betty, you kind of teed up the idea that relationships are the currency here, and that is the core. That is absolutely how we operate. Within West, we have a pretty broad mandate. We have committed to 100% mission alignment across our balance sheet. So that is across asset classes from our cash positions to public equities and fixed income to the private markets. In the private markets, we have two sub portfolios. We have a catalytic portfolio, which we really consider as patient, flexible, and risk tolerant. And we have a thematic portfolio that is seeking more traditional kind of commercial rates of return, but looking also to build diversification for Wes as we steward the balance sheet across geography, asset, sub-asset class within privates, and also sector. So from that perspective, we are in some ways balancing the considerations of risk, return, liquidity, and impact within every single investment we make. Particularly within our catalytic portfolio, we are deeply focused on that impact first, as what, Betty was sharing at the top. And we think about impact in three ways. We think about the who, the what, and the how. And so particularly within the who, we're looking at both the organization and then who they're in support, right? So for example, with BII, we were looking at the proximity of the leadership and how close or aware are they into the problems that they're looking to solve, right? And that was BII is a leader in that space, just given the participatory kind of governance of the organization and how deeply rooted it is in community. from there, we look into the what, right? What is the nature of the investments the organization is making? Does it align with, for example, the impact themes we have within WES, which largely are focused around supporting economic inclusion for those traditionally locked out of our systems, particularly immigrants? Then we look into the partnership kind of piece, like I was saying. Is it kind of the catalytic partnership? What's the strength of that? The strategic partnership, given the other parts that WES, holds in regards to our other activities, whether it's products and policy and philanthropy. What is the nature of that kind of relationship, and where can we be value add? And the learning potential. I will say we are very deeply focused on a learning agenda for every single investment we make. And so try to look into the organization, and their ethos is learning and kind of reflecting part of the culture. This webinar is a great example of that. But also, how does that then feed into WES as we look to continue to evolve our model?
Hmm. And so, Smitha, then what made BII a yes? You kind of pointed to it a little bit,
Yeah.
but if you could, just sum up what it made it a yes, and what was kind of the most important piece when you considered BII.
Yeah, there are several parts to our diligence process. In that impact diligence kind of phase, the first phase, the values alignment, the language that BII was using around trust-based investing, Wes also was using that language at the time. Really, the idea of integrated capital. So much of what BII is within the local context is what Wes is also trying to demonstrate within our spheres of influence. And so this is where there was such deep alignment in how we're working and kind of who our teams were and the values they're in. So that was so clear from the front. Then kind of really leaning into the governance model, how it was grounded in community, how it was co-designed. I loved that term. It's really an active word. How are you co-designing the fund? I felt like from my side, we were not a passive participant in the conversation to design Fund 2. Wes was one of the first institutional investors in Fund 2. So we really were kind of having a lot of conversations with the team as you all reflected on Fund 1 and transitioned into Fund 2 on the learnings and how that may shape the strategy. But that then led to this really organic conversation of what could a partnership look like and what that could mean in regards to fund structure as well. We were also really motivated by the opportunity to really explore place-based investing. WES is a global organization, and so we actually work. We have offices in the U.S., Canada, and India, but we have investments globally. The idea to really learn about the place-based nature of your work at BII was something we were really interested in learning. So that's something actually up front we had in our learning agenda.
Hmm.
But with all of that, of course, we got into the kind of the core of the investment diligence, which really gets into the financial kind of the rigor and kind of the prudence of the investment, and that also continued to validate our conviction into your work and why we were kind of an early partner.
Hmm. Yeah, and I want to I'm going to skip forward for a second and just ask, so if there's an investor that's on the fence about catalytic or below market returns, what actually shifts them? Like, how does that how do you get convinced?
Sure. So we often think about the spectrum of capital, and West does invest across that spectrum.
Hmm.
Every organization has its own constraints, but it does also have its own opportunities. So I think the question for every organization is really what are those opportunities? What are those constraints? Let's name them up front and then build that into the governance of how you steward your resources going forward. For some organizations, you could define a piece of your corpus that is perhaps catalytic capital. Maybe it has a kind of a longer time horizon or is a little bit more gracious in regards to the risk return profile it's looking for. In other instances, it could be an active allocation from your balance sheet. That's what Wes did in regards to our 100% mission aligned portfolio. So I think it's really kind of getting to terms with what are your opportunities to lean into catalytic capital and getting kind of educated about that. And then really going into the work of where do you see investment opportunities where traditional markets are not going? Perhaps it's broken markets or really underinvested markets. in our case, perhaps it's also seeding new investment tools or models that, just need a little bit more time and runway to get, the attention of the traditional capital market. So we've seen a lot of different use cases for catalytic capital, kind of that seeding, kind of scaling and sustaining as being the three kind of use cases of catalytic capital. But oftentimes, capital isn't flowing where we want it to. And so you need to really rethink the tools in our toolbox of an investor, and perhaps have a different outlook in regards to time horizon or risk return. And that's why we really do, really spend a lot of attention to our catalytic capital. And there's a world where some of those catalytic investments become part of our, core private equity or venture private credit positions over time. There's other cases where it really just doesn't make sense to scale within that kind of set of parameters. So we look at a variety of different almost exit opportunities for our catalytic partners.
hmm And so, yeah, you've named sort of all of the things that an investor needs to keep in mind as they're considering, or asset owner needs to keep in mind as they're considering investing into a fund like this. What do fund managers sometimes miss or do wrong or, not highlight when they approach an investor like you? Because we might have, folks on the call who are really
Yes.
interested to hear these tidbits of like what could they do differently or what are they missing?
I think what is a really productive way to start the conversation is kind of thinking about that partnership relationship first, right? Making it more of a relationship-based conversation than, say, transactional. And that's where the conversation around why Wes, why this organization, where do we see potential for the two organizations to work together? Is there a collective learning agenda there? I feel like Betty and I talk often around, are there things each of our institutions are doing that could actually move the needle for a broader field, to move into trust-based investing or integrated capital or you name it. There's a ton of overlap in our organizations, clearly, but there's so much, it's compelling to think about the investment even beyond our check, right? What else can we do? I know that both of our organizations also talk about a variety of types of capital, right? It's not just the financial capital. It's the network capital and the influence capital and the knowledge capital. How do we activate all of those tools that each of our organizations have and make that, more of a meaningful impact across? So I think that is in some ways a more compelling way to start a conversation with a prospective partner, kind of really looking at understanding one another and where there could be value together. Of course, I think we have to also be upfront about risks and returns. I think sometimes folks are, maybe brushing under the rug particular risks that they may have. I think there's a lot of credibility when you're a bit more forthcoming about that and actually proactively talk through the mitigants that you may, foresee in your work. And really thinking in our case for those impact first types of investments where impact is really front and center, it's strategic, it's not marketing, and it actually does drive better returns all around. So I think that's something that we do look for in our partners and make sure that it's really authentic.
Yeah. And Dominica, maybe we can bring Betty in for the Q&A. We can spotlight her. But as I ask this last short question to you, Smitha, if you were advising someone in this room raising their first fund, what is like a quick piece of advice that you would give them about approaching an investor like you?
Well, I think in some cases it's helpful to start the work before you maybe raise a more formal vehicle. So we've seen many of our partners look at maybe warehousing a deal, trying to think about ways to get a smaller group of maybe partners or investors to do a deal or two. I think that really helps kick the tires, first of all, on your investment strategy and demonstrate some early track record. So to the extent you can build that muscle and kind of early track record sooner than later, that I think will speak volumes to the strategy and its ability to bear fruit. The
Mm-hmm.
co-design piece, I just, to name it again, I do think we want to make sure that folks are really listening, right? Listening first to what does the market need, what do communities need, and then what do investors need, and really looking at all of those perspectives together. I think it's a very hard thing to do, but when you're doing it in a way that's inviting folks in, it is much more productive and it is more durable, is what I've seen.
Mm-hmm.
And I think that the idea of champions, Betty said this, that's probably the last thing I'll say. This idea of champions, I think it is once you have that kind of first champion, how do you also leverage that organization or partner to support you in your fundraising journey, right? So I think that's really critical, but would, sometimes it's helpful for someone else to hear about you than yeah, you pitching directly, right? So how do you build that network around you of champions? I think can really be effective. But I'll probably pass it back to Betty if she has more advice on that front. I think she has more of the direct experience.
Well,
Yeah,
oh, sorry, go ahead,
yeah,
Betty.
no, I just wanted to jump on that point on the
Yeah.
champion, Smitha, because
Mhm.
and you served in this role too, where an institution that was maybe new to BII or new to impact investing wanted to hear from another investor, right? So even serving as a reference, being willing to share your perspective. Some of our investors were willing to share diligence memos, right? Obviously caveated with non-reliance, but that's a that's a pretty big step, I think, that some of our investors were willing to take, and it opened more doors, right? It validated who we are. And I think sometimes we underestimate the importance of that, right? Just being a reference. And some of our entrepreneurs too were references, right? For us, for how we do our work.
Yeah.
So part of it was asking, right? Sometimes we're hesitant to ask for that from our investors. And I think in this community, like you made it easy, right? You said, what can we do to help? And you gave us that door opener. So
Yeah.
thank you. Yeah.
Betty, I'm going to stay with you because I'm looking at the chat. We have a great few questions here, and I'm going to try to get through them if possible. But bear with me, folks on the call. If we don't, we'll follow up with you. But one question we had from Kayla was, did you have for Betty, did you have to make or explain the case of integrated capital to philanthropic funders, or did they get it? And these are ones that also give you grants.
Yeah.
How much education was required?
I think everybody's learning, right? So there is a bit of education around what is integrated capital, what's the role of it, where does philanthropy sit in, if because philanthropy lives in the integrated capital for the fund itself, right? And so because oftentimes in our organizations, in a foundation, your investment capital is completely separate from your grant capital, right? They're definitely live in silos to some extent. You have different teams and staff, right, that are responsible. So there are foundations like even Cerdna Foundation, right? It is been a great partner. They're a philanthropic funder, but they've been on their own journey to learn about, right, impact investing. They have an allocation for impact investments as well. So I think it's we view part of our work as being both influencers of how capital can move, and being there to provide shared learning. So yes, it's education, but it's learning together, I would
Hmm.
say.
Yeah.
You know, you know, I think this challenge of that philanthropy doesn't want to fund infrastructure, I think that's an evolving area, right? Of just really making clear what does philanthropy actually do in a fund, right? It's not just um, providing program funding, right? So oftentimes philanthropy is used to provide what we call technical assistance, but that's funding a program and it's restricted, right? It's really constrained. And I think part of the shift I've seen in philanthropy is trust-based philanthropy as well, where I'm going to give you an operating grant, no restrictions, you use it in the way that you need, right? Whether it's to build your back office, to add new staff, to build your storytelling, impact investing, reporting, and management. All of that is really important, and it gets funded by general operating dollars.
Hmm. Thank you, Betty. Smith, I'm going to hand it over to you. We got a question from Katie. She wanted to know, how did Wes get to yes on catalytic capital, and who did you have to convince, and kind of how? What convinced them?
I think what I've found in catalytic capital is it's been most effective and possible in the realm of possibility when you're looking at grant making plus versus investment minus, if you will. And so from that perspective, we had a carve out for Wes for philanthropic grant making. And we were looking at the time to add impact investing as another tool in the toolbox to scale those social impact partners. And that was a really effective, frame. I think I've seen many organizations who are trying to come to it from a market rate kind of positioning or the terms that they use, right? Commercial rates of capital and saying we want to move into catalytic capital. And that's where there's a complete mismatch of the orientation. There's a bit of unlearning, if you will, that those folks need to go through to understand that missing middle in the markets that I'm telling you about that are broken and those investment structures aren't going to reach whatever profile you have in regards to risk return. I found that catalytic capital is much more possible when you have kind of the grant making plus, if you will, and adding it as a tool. And I've seen that across the board. So that's where I'm spending a lot of time talking to grant makers saying add impact investing as another tool or impact first investing as another tool. So that's where Wes started and it was really effective. And now that we had the wedge in 2020, now we're trying to broaden that wedge, right? Like we started with a 4% carve out for this. Now we have a target of 15% over time as Wes moves to 100%. The question around what is enough for Wes is real. A lot of individuals have this conversation, but institutions do not. And I'm really interested in what does at the institutional level it looks like to say what is enough and where maybe catalytic capital could be more of Wes's portfolio over time. But at least we have the wedge to start.
Mm-hmm. Mm-hmm. Smitha, I'm going to stay with you quickly and then I'll circle back to this other question because I can answer it. But Charles Wade, hey Shaka, good to see you. Thanks for joining us. He had three quick questions for you, Smitha, so
Okay,
I'll
do
share
that.
them. So, who are some of Wes's peers? Who are other investors who act like you? And then there was a question around how long is your diligence process and how do you
Mhm.
measure success after investment?
So peer set, I mean, in the regards to 100% Michelin portfolio, it's unfortunately just a handful. I think I could count it on one hand, perhaps two. A lot of people have made the commitment, but when you look under the hood in regards to have they updated the investment policy statement? Have they shifted any internal practices or have they hired people? That's where the number gets smaller. So it's a handful on that side. On the catalytic capital side, impact first, I have been seeing increasing interest in impact first investing. Certainly hearing about it more at conferences and Impact Alpha, for example. The Catalytic Capital Consortium C3 is a good community of catalytic capital kind of peers that we have. So I do think that has some good momentum. Diligence process for Wes, we try to keep it to a quarter, and that's really from start to finish. Once we turn it, we hit go on that impact diligence. I think to Betty's conversation earlier, there's oftentimes a lot of just relationship building and trust building that's happening well before that, but from kind of when we're really digging into an investment opportunity to end, that's what we commit to. And measure success, we look at it across multiple dimensions. Of course, we look at the impact kind of measurement management. We're also looking at the financial kind of stewardship of the organization and those parameters. And also, we are looking at that learning potential, the influence potential, the learning potential, the kind of the broader strategic kind of potential of the organization to support Wes. So we're looking at it across multiple dimensions, and we have a great colleague on our team that really is leading that work in-house.
Thank you. I'm answering the other question in the chat. I'm almost done, so I will send it through. And maybe I'm gonna wrap us because we are almost at 4. I will put the other answer to one of those questions in the chat in a moment. But Betty, I'm gonna hand it to you to close us out on this great webinar.
Yeah. Well, Smitha, thank you for your insights. You've been an amazing partner to us and just appreciate you sharing your wisdom with us here as well. And Aliana for your stealth guiding of this conversation. So, to close this out, I want to leave you with a couple thoughts. So one is, there isn't a shortage of capital. We saw the numbers. It's how do we build an infrastructure together, a relational infrastructure, so that we can have more of this impact first capital, catalytic capital flow into our fund managers and our communities. As maybe we shared earlier, we also train impact fund managers to launch community-based funds, and 29 funds have already launched across the country, right? That are driving economic justice, that are building community-owned real estate, and they're raising their first checks. So we want to be part of helping to shape the way capital flows into new funds. We launched a first mover fund, which is writing that first check. So our goal is to help our fund managers move 100 million into community by 2030. That means we need to write more checks. And in order to do that, we need the full weight and support of this entire community that's here. So super quick, if you are an investor, what can you do? Write a first check, back a new manager that doesn't look like the traditional ones that you funded before. Be open to accepting more patient timelines, what we call regenerative returns. Be a champion, right? We talked about opening doors and being there to support the managers you are investing in. If you're a funder or foundation, really important right now, treat philanthropy as this infrastructure layer, not just a subsidy or overhead. It's really necessary to build, right, the structures that we need to effectively move capital into community. Move past that 5% if possible. And believe me, I know it takes a lot of work. If you're an advisor, you're the highest leverage person in the room, right? Your endorsement means more than what we could ever say, because you're the gatekeeper, but the influencer. So maybe make a commitment, to meeting or diligencing an impact first fund, right? Looking at a non-traditional manager and making a recommendation to some of your clients. And then lastly, if you are a fund manager, we have a bunch of our friends here, start with co-design, warehouse a deal, as Smitha mentioned, prove your pipeline that way, and then build the coalition of champions, right, that you need to help steward your raise along. And then I found this really valuable, share your learnings. We share our learnings through our fund manager program, but share learnings because that also helps to open doors. So I'll end with this, right? We talked about solidarity finance, right? This infrastructure for solidarity finance is what we're building here. And it's funds like ours and funds like the ARC Fellows that are coming out of that network that are proving that this kind of deployment, this kind of capital can really help to bring the impact outcomes we want to see. Community ownership, generational wealth building, employee ownership and power. And every person in this room can be an architect of this future. So we invite you to stay with us and build it alongside us. Thank you.
Thank you, Betty. Thank you, Smitha, and thank you all in our audience for being here today. The full report, Lessons in Solidarity Finance, is linked in the chat, and I believe you can find it on the QR code here on the slide. We will sound out the recording of this webinar in the next few days, and please, check out the report and email us. Let us know what you think. We'd love to be in conversation with you. Thank you all, and have a wonderful rest of your day.